First, Liesman, I want to ask you about an ADP of 275 would indicate what should this number have been, above or below that? And was that a good number? Did that predict 263, or should it have actually been above 275?
Joe, I think it's so interesting. That was the first thing that ran through my mind, was that sort of strange interview we had with Zandy on Wednesday, where the number came out ridiculously strong, and he backed off and said, no, that's not the right number. Well, guess what? And by the way, I'd like to say, to my somewhat credit, was that when ADP ends up being above consensus, it seems to have pretty good predictive power of an above consensus number. For whatever that's worth. It doesn't get it exactly right, but it does sort of lean you in the right direction of the way the number comes out.
So
I can tell you what.
It was pretty good?
It was pretty good, yeah. So my model, by the way, treats the ADP number with a bit of a depression on it. So if I plug 275 into my model, it gives me back 259 for the private sector.
God, it's exactly
so
what
that's
it was.
what it would indicate.
Yeah, well, I didn't understand that interview like you, but it's so bizarre.
We were both hopefully people were watching and they understand what we're talking about, but it was strange.
Right. My question is if you're on the board of the Fed this morning and you're looking at this number, you're thinking what?
Steady as it goes.
You're thinking wages were 0.2%, 3% over the last 12 months. Inflation remains low, even if you think a bunch of that is transitory. I don't think you're seeing a lot in this report to worry about. Plus, even on the household side, the employment population ratio didn't improve. The unemployment rate down, participation down, overall employment rate flat. So it was a good report. I don't think there's any reason a bond market should be scared about a report like this.
Well, the good news is, Andrew, we're not going to have to wait very long because there's so many Fed speakers today that are going to basically be running these numbers, through their kind of rhetorical filter. And the bond market thinks, though, that on a net basis, this makes the Fed slightly less likely to ease, more likely to look for an opportunity later on to hike. But it's interesting because the linkages between this number and what the Fed's going to do have loosened up, right? We're maybe going to tolerate higher wage growth.
Let's get to everybody else. Rick, David, who wants to go? Rick?
Sure. I think it's a great number. I would have liked to have seen the work week, a little higher. I definitely wasn't impressed with the participation rate, losing a couple of tenths. But all in all, not a bad number. And, interest rates are ticking up. We are now looking at the dollar index once again overtaking a level we haven't spent a lot of time at since May of 2017. I don't know what Goldilocks is, and I know everything gets benchmarked against the Fed. But, all those static comparisons, if we freeze right now, here's what's going to happen 3 meetings down the road. That's a useless mugs game. We don't know because those couple of months in the middle, that's the whole game. And I think everything's acting quite well. As a matter of fact, I think, if we get a trade deal, that most likely could be a deflationary event. That most likely is going to excite stocks even more, thinking, Fed's going to see this and really think inflation's going down. So I think there's a lot of bright spots. And one thing I do want to address, this is kind of strange, but we did have some March inventory numbers nobody's paying attention to. I noticed retail inventories were down 0.3, wholesale inventories were about unchanged, downward revisions. Why am I mentioning that? Because 3.2 GDP first quarter, first look will get affected a little bit by these numbers. And trust me, if that revision continues to hold the 3 handle, I continue to say that our starting point was so much better at the beginning of the year. I think it enhances the possibilities of where we can end up.
So, David, I guess,
I see this as very good news. I think both of the Federal Reserve mandates, unemployment, keeping that low, and low inflation are on or even better than target. I think it actually does give them room to continue to normalize, but they'll have to be careful on the timing and do it as steady as they go.
So where are these jobs coming from if no one's around to I'm still wondering that the late, great Alan Kruger or thinking about Zandy, we talked about him, but for a couple of years he's saying 200 is not sustainable because it's just the workers aren't there to satisfy the demand. Where are they coming from, Liesman?
Joe, I would ask Alan Kruger this question almost every month as these numbers came in, and I'm pretty sure what Alan would say was if you have a large increase in employment and a large increase in unemployment, a large decrease in unemployment, That's along with his theory. So what you're doing is you're taking people who are unemployed, in other words, part of the workforce, because remember, to be unemployed, you have to say you're available to work, right? And they say, look, that's exactly what you would expect to happen. You're driving down the unemployment rate. I do want to make one quick note, Joe, here, which is not to focus on the negative, but something's going on in retail. I think we know what's going on in retail, but here's the series of numbers. Minus 14, minus 15, and minus 12,000 for the last 3 months of retail. Now, it's very interesting. This could be an internet story. And by the way, the job's being classified someplace else. Or maybe there's this massive adjustment that's going on in the retail business that it's worth watching as to what's going on in that space because it's been pretty consistently negative right there.
And Joe, as you see consumers move to the Amazon platform, your retailers are going to have to adjust their costs. It makes perfect sense with what we see elsewhere in the market.
Jason, what could we do as an average per month? I mean, can we do 200 as an average for this whole year? Is that still possible? Because everybody said we're going to go down to 100 in a tight labor market.
Yeah, look, last year we were at 223. This year we're averaging, I think, about 205,000 jobs a month so far. You know, I would take the under on 200 for the year, but we're at a pace way higher than what I thought. And, you know, the participation rate over the last year is flat. That's amazing in an economy where a lot of people are getting older, a lot of people are retiring, and it's those people continuing to come in. You know, how much longer we have of it, I don't know. Is it 6 months? You know, is it 2 years? Is it over this month? I think it could be any of those.
Jason, is it time to change the framework? That's really the question. I think, you know, I give Joe a lot of credit for kind of questioning the framework by which each economist comes on and says, you know what, and the Fed says this all the time, 80, 100,000 workers per month is what we should be doing. And after 6 months, you know, we're going to go back to it. After a year, we're going to go back to it. It seems to me that maybe the framework of thinking about the population of labor out there is perhaps wrong here.
Right. I mean, the question is, how much weight do you want to put on what we've learned over the last 40 years versus what we've observed over the last 4 years? I don't think you want to overweight the recent past too much, but you probably don't want to ignore it either. So, yeah, I'm starting to think steady state job growth is above that 77,000 a month. That would be the demographically constant unemployment rate. But it's not $200,000 a month. That's just not steady
this
state.
Productivity piece in the journal. I don't know if
piece,
I do. I just want, because that's the missing link for how we could.
It's a huge deal, Joe. It's you know, here at this monetary policy conference last night.
He wants capital investment to back it up. He says, or business investment to back it up. He says we're not seeing that.
There is business investment, and look, among the things the government does badly, counting capital spending probably is up in the top 3 or 4. I will say that at the Hoover Institution dinner last night before this conference, a lot of buzz about that productivity. A lot of caution because it's a volatile number quarter to quarter, but you've had a couple good quarters of it. You've had this, if you put up a chart, you can do a rising trend line over the past year. If that turns, it changes everything. It's very hard to know if it really is turning, but it's a big deal. You have had you've had the, well, it may be. Look, I think just the economists are going to be a little more cautious than the political side of things, who want to say it's already there. But you know,
the trades.
What, Rick?
That's why they miss all the trades. By the time the economists are convinced, it's adios. You know, the signal is way in the rearview mirror. That's the whole point. Economists are brilliant. They're always brilliant. They didn't anticipate.
Right, and every trader, Rick, and every trader makes money.
Rate. I didn't say
and
that.
every
Listen,
trader
stick
makes
with
money
the topic.
all the time.
I'm
Rick.
trying to make viewers some money. If you wait till economists and most Fed officials are convinced, that's when you ought to be cashing out at the window.
Every trader's always right.